Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Vincent Deluard of StoneX. We're going to be talking about value. We're going to be talking about gold. We're going to be talking about the MAGA stocks and what the next 10 years is going to look like coming up right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Vincent, you're from StoneX. What's your role at StoneX and what is StoneX?
Sure. I'm the director for global macro strategy at StoneX. So my role is to try to come up with something interesting to say about markets every week, which seems easy, but is a lot harder than it seems because a lot of people think they have interesting things to say about the market. So it's a crowded field. So we advised pension funds, institutional investors on topics like asset allocation, sector selection, country rotation. I do roadshows, presentation. I write a report every week, which I'm sure we'll discuss later. And in general, it's a lot of fun. I mean, I don't tell my employer, but I would probably do it even if I were not paid, because that's what I've been doing all my life. That's what I enjoy doing. So I'm very fortunate to do that. As far as StoneX, StoneX is probably the biggest firm you never heard of. It's actually a Fortune 100 company where I work for the broker-dealer division, but we're a global financial service firm. We have a big commodities group with whom I work sometimes. So I go to places like Kansas City and St. Louis and actually meet a lot of very smart people there. We have a big currency management unit, and then I work for the securities group. Lately, most of my clients have been in Latin America. I work a lot with pension funds in Chile, Peru, Brazil, Colombia, and it's really given me a very interesting perspective, very focused on real stuff, whether it's commodities, grains, ags, the firm's been growing very fast. We are, listed on the NASDAQ. The ticker symbol is SNEX, and I think we're doing good.
I love the notes that you write, and as I was telling you before we went live, I read through and laugh every time I read them because I find them. You and I, mostly because I agree with you on most of the things that we're going to talk about in a moment. Let's start with an easy one. Inflation, transitory or here to stay, and why?
Well, I think today is a good day for me because it's not transitory would be my answer, and we're starting to see. It's possible that we get a soft patch, just because of base effect. I wouldn't be surprised if the next couple reports are a little slow down. But I think
base effect in the sense that a year ago or 15 months ago now was like the low of the whole COVID crash.
Correct, and I think that's part of the, even in the way you frame the question. The answer is both, right? I mean, it's transitory and secular, and I think there's a level of dishonesty, ingenuity in the Fed when they mention, it's all base effect, and yes, these things are here. I mean, no one's questioning that, but you have also other secular dynamics. So my outlook for inflation is, yes, right now, indeed, I kind of agree that the biggest driver of inflation is what you're describing, which is a year-over-year effect on the commodity. I mean, it's not so long ago we had negative oil prices. Today we're above 70, so infinite growth rate, and it's lumber, and it's copper, and it's semiconductors. I mean, all the things you know. So that's what's hurting right now. But and yes, maybe some of that will subside. By the way, I'm not sure it will fully subside. I think, for example, if you look at the price of oil, yeah, sure, we went from minus 40 to 70, so I don't think we're going to go to 150 in it, but I could very easily see oil prices stay in that 70, 80s range. Same thing with a lot of commodities. We have these kind of structural supply issues that will not get solved. So the fact that a lot of it is from commodities doesn't mean it's going to go away. It's going to slow down, but then I think what's going to happen as we progress towards the year is we'll see this almost smooth, seamless transition between this cyclical inflation and secular inflation. Secular inflation being driven by things such as labor shortages, wage price spiral, of rents, like the stickier parts of the CPI are going to take over. And I would stress that these things matter a lot more. I mean, commodities like 10% of the CPI, shelter is 40%. So people love to point out that, oh, it's all because of oil prices, take that off. Well, what people don't realize is we had the exact other effect on the shelter part of the CPI, because as a result of COVID, we had all these rent moratoriums. So we've seen massive disinflation in rents. So rents used to be running at 4% pre-COVID. They fell to 1%. And you know how the Fed computes this, I call it a BS number, but they call it the owner's adjusted rent equivalent. Really, which effectively tracks rents, not the Case-Shiller index, which I think is wrong, because at the end of the day, people, when you buy a house, you pay the market price. You don't pay the Fed construct. But whatever, let's not even get into that. The point is, that fell from 4 to 1. Now, I hear a lot of people say you got to take out the commodities because it's a COVID story, and it's overestimating. I hear no one saying, well, you got to correct for the rents. And the rents we know is going to correct because, of course, the moratorium is going to end in the fall. And, if you've been in the market for buying a home, I mean, you're in LA, I mean, now it's everywhere. It used to be the big cities. Now it's everywhere. So yeah. I think the story of the next decade is going to be secular inflation, and we had the very dawn of it, and we had 4 months of it, but before that, we're 40 years of disinflation. So, as far as where portfolios are, where investors are, where risk is, we're at the very, very early stage of this move.
One of your notes has the 7 best arguments against inflation, and one of the second point that you raised is labor slack. Just anecdotally, I've been driving around or on the Twitter or on the internet, you see lots of references to people having difficulty hiring and having difficulty hiring at old rates. So they may have to hire pay more to hire. What's driving that?
I think part of it, I mean, the common answer is government paying people to stay home and watch Netflix, which, it's kind of a Fox News talking point. I mean, there's some truth to that, but to me, like, I think it's changes in behavior from COVID, structural changes. One study that I thought was eye-opening found that Americans took, I think it was £2 per month of lockdown. So, I mean, in California, we're of lockdown. So that's about 22 pounds that people took. And I mean, you were starting from a base of a population where you have about 30-40% of the population that's morbidly obese. And that can be debilitating. And I mean, anyone who struggled with weight loss knows that it's not just because you can take off the mask that suddenly you're going to lose the weight. So another stat that I found scary was on mental health. 40% of teenagers report struggling with severe anxiety or depression. And again, these are debilitating disease. And then this is not just because Mr. Fauci say you can go out now, it's all good, that's going to go away. So I think we're going to be scarred by COVID for a very long time. And the labor market coming out is going to be very different from the labor market coming in. Which is why I think there's a bit of a bad faith when you hear like Neil Kashkari or some of the doves at the Fed say, well, cannot have inflation because the unemployment rate is 6% and we're at 3.5 before COVID. So we're going to run that baby hard until we get to 3.5. Well, that assumes, all else equal, ceteris paribus. It's not ceteris paribus. The labor market has changed, and I think that fictional thing that economists talk, the NAIRU, non-inflation accelerating rate of unemployment, natural rate of unemployment, which you only know after the fact. I think before it's probably possible that the Fed overestimated the NAIRU, we could go lower, but now it's probably underestimating it, meaning that the true NAIRU is higher than what it is because people have struggled from the pandemic, and also some people have just changed their priorities. It's like, hey, I don't need to work anymore. Like I figured out a way. I rent something on Airbnb. I can drive an Uber here and there. I need to take care of my kids. I need to take care of my parents. This is a kind of major event that will change people's behavior. And the Fed, again, we don't have a precedent, we don't have a model for that. So I think the Fed is just ignoring it. I will also stress one last thing about the labor market is a structural shift that was pre-COVID, but that was accelerated by COVID, is the rise of the gig economy. And I think that changes the dynamic in the Phillips curve. So historically, I think the intuition behind the Fed's dual mandate is you have this trade-off between inflation and unemployment. It's basically, hey, if you don't work, you don't eat. So once the economy goes into recession, people don't have a job. Because they don't have a job, they start like bargaining less for wage, and wages fall, and that's the regulation mechanism of the economy. I can argue it's a very barbaric one. I would say it is. Like it's kind of sad that in order to run the economy, we need to threaten 20% of the population with starvation. But that's how it's been for millennia. But again, the labor market has changed. It's no longer this kind of black and white employment and unemployment thing. Now you have this gray zone of gigs, right? So you lose your job. Well, if I can just log on my cell phone and register, sign up to be a Uber driver. I'll be one. I can start driving tomorrow, or a DoorDash delivery. So you have this gray area where people, I think if people lose their job, then they're not going to come back to take a job for like $10 an hour because they have that option, and that's going to change the Phillips curve. And I would argue that's going to make it less elastic.
One of the arguments that you put forth that I found reasonably compelling is that there is going to be this deflation as a result of technology, which just does seem to have been the case over very long periods of time. Why is that not a valid argument?
It is a valid argument. It is over time. That's the main reason why prices don't go through the moon, is because humans are smart and knowledge is cumulative, and we get better at doing stuff. And historically, shortages of stuff have been replaced by human creativity. I mean, you can think about the Industrial Revolution, like England ran out of wood, so they had to dig coal. Coal was better source of energy than wood. And then you move to the oil age, and then maybe you're going to move to the renewable age. So yes, I believe in that over the long term. Over the short term, I do not really see it. If anything, I see this massive push to go into renewable as extremely resource intensive, at least initially, because you got to redo the grid. You got, if you look at a windmill, I mean, it's a lot of steel. Battery, it's a lot of cobalt, it's a lot of nickel. Things that, by the way, that we don't have a lot of. We don't know how to, because these things are fairly new, at least in terms of the volumes that we're going to need. So even if you want to be a techno-utopian and think we're going to go all drive electrical vehicles and renewable, there's going to be massive investments required to do that. And it will be inflationary first, deflationary later.
So you've made a pretty compelling argument, I think, for inflation. What do investors do when they're confronted with this? So you've written a note where you break it down by asset, sector, factor, and some stocks. But let's talk about what, from an asset allocation perspective, how do you approach a problem like that?
Well, I think the first thing that investors need to realize and seriously think about is what I call the nuclear winter of the 60-40 portfolio. So the 60-40 portfolio has really been the bread and butter of our industry. And frankly, a lot of people have gotten very wealthy working very little in the asset management industry because, things just went up. What was it? The 444 for bankers, right? You charge at, I don't know, 4% on loans. I know I forgot the other one, and then you're on the golf course by 4 p.m. Right? I mean, that's kind of how it's been in the asset management industry. Yeah, okay, give me your money. I'll buy stocks and bonds. Don't look at it. I'll charge them 1% management fee, and we'll all be good. I think that's over. It's over just because the 40 is irremediably broken. The bond allocation is. I mean, I was looking at VBTIX, which is the world largest bond mutual fund by Vanguard, and I found that 99.9% of these bonds yield less than 4.5%. Now, why do they use 4.5%? Because that is the return assumption that Vanguard builds in its target date retirement calculator. So they tell you, come retire with us, you're going to earn 4.5%, but then they put you in a fund where 99.9% of the bonds earn less than that. So it's a joke. The other part that's broken in that 60-40 portfolio is a negative correlation between the two assets. So, for a long time now, yields have been low, right? But you would still want bonds because of the diversification, right? You are not getting much return, but because you reduce the volatility of your stocks, you still improve your risk-adjusted return, you're sharp, and you could even add on leverage because of that. Well, for the first time in about 20 years now, the trailing 6-month correlation between stocks and treasuries turned positive. And again, this is what you see in an inflation environment. This is the norm. I mean, there's nothing normal about the prior environment or this one or whatever. That thing flips based on inflation. And in the 70s, in the 80s, all the way up to the mid-90s, stocks and bonds were positively correlated, which is where we are today. So which means that, more likely we're going to see both stocks and bonds drop at the same time. And people who are in 60-40 or even the leverage version of it, which I would argue is what risk parity is, are going to be facing losses on both sides of the portfolio. So that's the first lesson. Second lesson, obviously, is to underweight bonds and long duration. I think duration is the biggest risk in your portfolio. And I think duration is a very creepy thing. People think of duration only as a 30-year bond. No, you have a lot of duration in biotech. You have duration in many of the growth names. You have maybe the longest duration asset could be Tesla, or it could be even, the 50% of the Russell 2000 index that doesn't have any earnings is not even able to cover their interest expense. So you have a lot of duration hidden. Even the duration of bond indices has increased, again, because agents respond to incentives. So when you have flat yield curves and very low yields, people take on debt and they take long-term debt. So if you look, for example, duration of the emerging market bond index, all-time high, duration of the junk bond, all-time high also. So that is, I think, the biggest risk is duration. And then, in terms of assets, so you take off bonds. I mean, and we'll go, there are areas that I like Latin America, for example. I think short-term, Mexico, Brazil, you get, potential for currency upside, re-rating, but that's very narrow. I also like some of the the Chinese government bonds and smaller markets around it, but that's not gonna, that's not a 40% type of your portfolio. And then we go to stocks. Stocks initially do fairly well when you have a bit of inflation, and I think that's due to the inflation illusion, something Keynes wrote about. At the beginning of inflation, oh, I'm getting richer, I'm getting a pay raise, so everybody's happy, which I think is kind of where we are. And then you realize, oh, everybody else getting a pay raise, and price of grocery store 20% higher. So then, but in that initial phase, which is where we are, inflation feels good, and stock multiples typically peak when inflation goes from 2 to 4%, which is, up until yesterday. Now we're at 5, but before we're at 4. And then after that, if you look at the relation between stock multiples and inflation, it starts falling because people realize, oh, inflation is here, margins are going to compress, and then generally just again the duration argument. I think inflation shrinks the time horizon, increases the preference for the present, and any long duration assets, which stocks are, end up suffering from inflation. I actually I went to one of the difficulty about inflation is that most of the data that we use for backtests is less than 40 years old, right? It's very hard to run and we had 40 years of this inflation. So most people do not even have the ability to test what inflation is for. So I was lucky. I went to the Pharma and French website on the Dartmouth And they've actually reported industry returns all the way since the 1920s, which got me 4 inflationary episodes. The one during World War II, the one during the Korean War, the one in the 70s, and then the little bout we had between 2003, 2008. And I found that of the 30 industries that they have, 27 have a negative correlation with inflation. That's kind of my point. Like, inflation is bad. I mean, I feel I should not have to say that, but the markets clearly doesn't seem to understand that. So I'm going to, for most industries, inflation is bad. I mean, the only 3 that had a positive relation were like coal, which no one wants to touch right now, oil and gas, and I think wholesaler was the 3rd one. The one that had the most negative relation to inflation was automakers, which I find interesting in the context of one large electric vehicle manufacturer, because, you know, car manufacturing, you know, your COGS, cost of goods sold, are like, you know, 80% of your end selling price. So like, you don't have that much leeway. Like, if the price of steel goes up, your margins go. And it's also a very competitive industry. Like, you know, back in the 70s, we had the European, after we had the Japanese. I mean, it's in the industry of oversupply, low pricing power. So yeah, by and large, I don't think stocks are going to be a good hedge against inflation. Obviously, within stocks, I prefer materials, I prefer gold miners, I prefer energy, but these are tiny. Like, the energy sector is 2% of the S&P 500. So the stuff that will benefit from inflation is going to be outweighed by the long duration complex in the stock market. And I think as a whole, inflation is going to be negative.
What about from a factor perspective? You took a pretty close look at that, and I thought there was some interesting outcomes from that.
Yeah. So the one that works best during inflationary period is value, which, you know,
I'm happy to hear that. That's why I raised it.
Yeah, you need all the love you can.
That's it.
Yeah, and I think it's going back to the duration argument ultimately. I think, you know, if you thought it's duration of stock like you would have a bond, value stocks are low duration. They're low duration because of the high dividend yield means you get your capital back faster, right? It's kind of like, you know, the duration of a bond with high coupon is lower than that with a bullet bond. So same thing. And then also you get some of that value is immediately realized because you're getting a low price to book, right? So the assets, you know, that you have right away, you're getting a claim on real assets that you can cash today, as opposed to growth stocks where the cash flows are going to come far out in the future. And then even the assets, which most often are intangible, will only materialize their value later. So when rates go lower and yield curves flatten, that helps growth. Conversely, when you have inflation, steeper yield curves and higher rates, that helps value. So I think that's the reason why you see the value anomaly fair bet. By the way, I'm not sure about the term anomaly. If you look at the Pharma French data, most of the returns from the value factors came from these short periods of inflation, the 1970s and the early 2000s. So I would not say that it's an anomaly. It's just, you know, a normal kind of ebb and flow. Inflation favors value, deflation favors growth. We came from 40 years of deflation. Now we're switching, and I think that's why you're going to see value do better. The other one that I find interesting is momentum, and I have my doubt about the Pharma French study, but every academic, you know, quotes it. So I'm you know, clearly I don't have a Nobel Prize, so I'm not going to question them here. But the return that the momentum fact they found for the momentum factor is so high that I find it hard to believe. You know, it's like 8% annualized alpha, whatever. But let's assume that's right. Momentum worked in both both inflation and deflation. I think the reason is because momentum is not really a factor. It's a chameleon, right? Momentum by definition goes with what works best. So for the past 40 years, momentum got you into big tech, the platforms, the biotech, and so forth. But as we're doing this transition, momentum is shifting. You can see that in the largest momentum ETF, MTUM, massive rotation. You know, I just rebalanced. I think, you know, 3 months ago, it was 80% big tech, pharma, work from home, like the pandemic stuff. And then now it's, you know, banks, energy, material. And I think that adds water to my meal, the fact that the momentum strategies now are picking up the value factor. And, you know, you'll have this intersection. Value is going to be momentum, and, you know, it'll be a little bit like a snowball.
One of the things that you point out as being a potential beneficiary of an inflationary environment is the US healthcare the companies that sell into that system. So can you take us through that argument?
Yeah. So I kind of had this philosophical view before that. I mean, I hate the US healthcare system, but I think I hate it because it's so good at squeezing money out of patients. And I do think that over the next, it seems to me that every decade is defined by one macro theme. So, when I came of age, the big story was the internet and TMT, and that was the story in the 90s. And that's what drove your returns for a decade. After that, in the 2000s, the big story was the rise of China, emerging markets, the BRICS, commodities, all of that at once. So that was another decade. And then 2010s, it was kind of coming back to the 90s, but with a more pro-business, pro-platform, instead of like the wide-eyed optimism. It was like, the Facebook and the Google and like the big tech platforms. I think healthcare is going to be that for the 2020s, like just because of demography, because of patterns, government spending, because of even people's preferences, especially after COVID, the importance of health. I think we have this massive crisis in how we eat, how we live. So that's kind of my view, that healthcare is going to be the driver of secular returns for the next decade. But specifically on the point of inflation, I came to healthcare just by running a screen on Bloomberg. So I looked for, my view was like, I call that the pricing power portfolio. I wanted to look for companies which had expanding margin despite rising COGS. So meaning you have inflation in your costs, but you're able to pass it to your customers and some more. I looked for companies which paid a dividend because, when you have inflation, you want dividend because dividends grow and coupons do not. So you can think about a swap between, an asset that's growing and one that's fixed. That's a good thing. I looked for companies that had a lot of long-term debt because if I'm right about inflation, that long-term debt is going to be paid out by inflation, like canceled out. So that's a good deal. And finally, I look for also companies that had some financial resilience, meaning that they had a high interest coverage ratio, which, that was really to weed out a lot of the kind of small caps, Russell 2000 like companies where you have a lot of debt, but you don't have the cash flow to support it. So I ended up with a portfolio of about 70 stocks, which is called pricing power portfolio, and 60% of that was into healthcare. And that fits well with my experience because the pricing power of healthcare is infinite. I mean, we're joking earlier about our experiences being foreigners and having babies in the US. And I mean, I still remember when I had my first baby. I mean, literally, I have the child in my arms, like he's bloody and screaming, get a call. What's your credit card number? It's 100,000. No, 80,000, man. I almost dropped the baby. Like I come from France, like, I mean, I've never had to settle a bill, like 80,000. And so then anyway, then I asked for an itemized bill. They couldn't even itemize it because, it's a BS number, right? So then they put stuff or, we did this. No, you didn't do that. I was there. I mean, my wife was there. That's the definition of the birth. Like, I know these things didn't happen. But then they're like, why are you arguing here? You got insurance. Your out of pocket is already done. Like, it's not your money. And I'm like, yeah, maybe it's me being French, but like, I was like, no, I just don't like being, taken advantage of. But anyway, long story short, that in healthcare, prices is not driven by inputs. It's driven by the power relation between the predator, which is the hospital in this case, and the prey, which is the patient. And that power relation is not going to change. I mean, if you look at the healthcare CPI over time versus the regular CPI, it keeps going up. I think it's also an area where you're going to keep seeing more money. I mean, spending money on healthcare, it's kind of like for Catholics, going to confession. Doesn't accomplish much, but you feel better after that, like especially for Democrats. Oh, let's put more money into healthcare. Everybody's happy with that. And it's also a way, I think, when people think about the stimulus, like they have this kind of 1930s view of it, the Tennessee Valley Authority going to build dams. No. You live in LA, I'm in San Francisco. How long have we been talking about the high-speed train between our two cities? Like 30 years. I think they be like 5 miles between Modesto and Stockton. I mean, this is not the age of big infrastructure investment. I mean, you got the NIMBY, you got the environment, none of that stuff's going to happen. If we're going to run these like, $3-4 trillion deficits every year, the easiest way to spend money is either bailing out states or spending on healthcare. And in a way, it's good. Healthcare spending is good. Like, it's good middle-class jobs that don't go to China, pays good benefits. So politically, it's a smart thing to do.
Yeah, that's fascinating. The thing that we haven't really discussed that I really want to chat to you about, let's talk about this is an extremely expensive market. What are the chances that we go into some sort of bear market? And how do you think about that process?
I think about it a lot with great apprehension and great confusion about what I see in the market right now. Yeah, I mean, you look at any valuation measure, whether it's Dobbins Q, stock market cap to GDP, Sheila P. I mean, we're way higher than we were even back in March 2000. Not only that, but it's also more widespread, right? 2000, you had, the growth complex was expensive, but the value stuff was okay. Like, in the bear market, if you own value stocks, you actually did fine. Not so much today. I mean, I can think energy and material is still cheap, but outside of that, it's really widespread overvaluation, and it's to a level that's absurd. So I think you're referring to a study that I put out on Twitter recently on what I call the hypergrowth stocks. So I was thinking about a certain actively managed ETF with a very charismatic portfolio manager, and talking about this amazing technological revolution that's going to happen, and you're going to get it now. It's growth at any cost, right? The idea is, if you bought Amazon 20 years ago, didn't matter what else you do, just because of that, you'd be rich today. So let's find the next Amazon and let's just do that. So I'm like, okay, fine. I am actually somewhat positive on some of the technological stuff. I'm in agreement with that crowd. I think it will happen. It will be amazing. The question is, can you capture these returns by buying stocks today? That's the question I want to answer. And my answer was no. So what I did is I look at all the stocks that trade at more than 10 times sales. I call that the hypergrowth stocks. There's about a couple of hundreds in the US right now. And then I projected on that the growth path of Microsoft, Apple, Google, and Amazon. And what growth are we talking about? I mean, these guys have seen their revenues multiply by 56 in 17 years. I mean, think about this. This is everything that I learned about economics was shattered, the diseconomies of scale, marginally decreasing return, margin tendency to reverse to the mean. These guys have grown revenue so much, and still they maintain 20 to 30% profit margin, in some cases increasing. I mean, these are extraordinary companies. And again, it's a unique time, right? It's rise of the internet, rise of the e-commerce, complete failure of antitrust to investigate or do anything. What a period. So I put that on and I say, okay, these hypergrowth companies are going to follow the path of Google or Amazon, and then that composite. And then I'm going to assume that because they're so good, they're going to trade at the same valuation at the end of the high growth period as the MAGA stocks today, Microsoft, Apple, whatever. And then I discounted that by 10% to the present to get a result. So I got two things. One, for 20 companies, the result that I got was so absurd that it made no sense. Like their sales would be bigger than US GDP, so that's not going to happen. And then for another 60, I found that the current market value was higher than that. So the market was already discounting an Amazon-like scenario and some. And then you got to pause here, and you got to be like, 60 Amazon in a year. I mean, it took us 4 decades to get 4 of these companies, and they're arguably the 4 most successful businesses since maybe Standard Oil or the East Indian Company. I mean, how is that going to happen? It can't. It can't.
So we're confronting an extremely expensive market. The interesting part of the market, which has been the hypergrowth SaaS stocks, MAGA type stocks, seem to have there's little room left to run in there. How do you hedge that portfolio? What's the way to, how do you protect yourself? What do you do?
Well, it's very, very hard, right? Because traditionally your hedge was long-term treasuries, and that's not working. So, and I don't think it's going to work because of that outlook on inflation. So 60-40 is not going to work. Now you go to other alternatives, like, well, I can buy puts, right? And I don't know if you've done some of that. I have. It's paying premium every month. Of course, it never happens. The market never corrects, and also that the implied vol is quite high. Typically at a market peak, you should be looking at a VIX of like 10, 12. We're in the 20s. Maybe a little less today, but generally we've been pretty high. And especially if you look at out of the money puts, skew are very expensive. Skew index at an all-time high. So paying premium, that's the most efficient hedge, right? Obviously, because if it falls, you get your money. But that is very expensive. So that's not a good solution. And then if you look at even traditional risk-off assets, not so great. So if you look at people haven't noticed because there have been very few corrections, but I actually ran a study of looking at how various risk-off assets have performed when the markets drop by more than 1%. And so I run it for the gold, long-term treasuries, the yen, the Swiss franc, and Bitcoin. And this year, all of them fell when the market fell. Personally, I still like gold. Maybe it's my ideological bias, so I'm willing to give gold a pass. I don't know why, but it's harder, I think, and that's what typically happens when people talk about crypto being uncorrelated. An asset is uncorrelated until it becomes so successful that then you get institutional adoption and then it becomes correlated. So people are kind of extrapolating from the past, which I think is wrong. But it is going to be very, very difficult to hedge. The one thing I would suggest, though, is taking a broader view of risk rather than thinking of risk as like, a 2 standard deviation move in the S&P 500 daily return. What are truly the risks of 2021? And with a list of 5, rising yields, rising spreads, rising inflation, stock market decline, or blow up of the growth complex. And for every sector, I ran a regression analysis to see how these things respond to these risks. And I took the sum of all these 5 risks and look at what protected you best. And what I found was the best protection came from the most cyclical stuff, in a way: energy, materials, commodities, but also the cheapest stuff. Which is I think the great news is that buying hedges is if you have this extended vision of risk, not just a 1% decline in the S&P 500, actually the big risk, which is rising inflation and associated consequences, you can hedge that with inflation sensitive assets which are still cheap. Conversely, the things that had the most exposure to these 5 risks were technology and consumer discretionary, where we've seen the biggest runs, the most expensive stocks. So that is, to me, the greatest news. The only piece of good news for investors in 2021 is that if they understand risk correctly, they realize that hedging that risk is cheap. And also, these are also the sectors where you get the most earnings growth. So it's very, I think, more than half of the earnings growth in the S&P 500 next year is going to come from energy and materials, coming back from a very low base, of course. But so I can see this complex where you have protection, cheap valuation, positive earnings growth. This is really the trifecta. You really see the stars align so well.
That sounds like a reasonable argument for value over the next sort of period of time. Not that I want to talk my own book too much, but that does sound like a pretty good setup for value.
It does, and like I said, we had 4 or 5 months of since November, maybe like the election and the vaccine news. So 6 months. We had 40 years of decline before that. So if you think about the cycle as this long-term pendulum swing, we barely started the move. And indeed, if you have to have an equity portfolio, I think value, because of its low duration, because of its sector exposure, is probably going to keep you out of trouble. So I would expect the market correction to play out very much like the 2000s, when the Nasdaq was down 80, the S&P was on 50, but if you only looked at value, you were barely down on the year, and then you recovered a lot faster.
I think while values had a pretty good run since whatever it was, September or November last year, it seems to have stalled out a little bit over the last month. That's been my sort of observation, and the market feels a lot frothier and more speculative recently. Why do you think that might have happened?
I think part of, and I don't really have a good answer, but I've noticed that I think that the value and the performance comes from the fact that yields kind of have topped out quite a bit, like 1.6 and then 1.5, and I think if you look at the growth to value performance seems to follow yield, especially I think part of it is because financials are such a big part of value indices, and financials respond to the slope of the yield curve. So as that has fallen, value has done less well. I think just be patient. Things are never linear. Obviously you'll get pause, you'll get pullbacks. I'm thinking of gold right now. I mean, you had a big pullback from gold too, right? From 2,000 to 1,700. Well, now we're back. 2,000 is close again. So if anything, I think that would be a time to kind of accumulate more so than selling.
Do you have a view on the gold? It's the commodity versus the miners. Does either perform better in the sort of environment that we might go into?
Yeah. So typically, I mean, miners are the most leverage you can think of on inflation, right? Because obviously they tie to the price of gold, but personal and financial leverage on top. One is the inflation of mining costs versus the price of gold. So you want to invest in gold miners when gold prices are rising faster than the input cost of gold. And so far that seems to be the case. So I'm not worried. Like, you want them to be able to preserve their margin, but it could be that 5-10 years on the road, because of labor costs, because of shortage of steel, yada, yada, that dynamic is going to change. For now, it's not a problem. Second thing is discipline, capital allocation. I mean, typically gold mining industry, I mean, I'm sure you're familiar with that. It's a bunch of cowboys. They have money burns a hole in their pocket, and they have a dollar to spend 10. That's what the industry's done for the past 20 years, but the market has really chastised them, and we've seen massive consolidation over the past decade, big focus on returning capital, paying dividends. So again, not a risk. And then the last part is valuations. Obviously, with any investment, your return is going to depend in large part from the price you paid to get in. And I would argue that, multiples in the gold sector are not too high. You can find like good, very solid company trading for 12, 13 times cash flow, which, compared to the rest of the market, it is a bargain, especially if you think, as I do, that its cash flow is going to increase massively in the next decade.
That's fantastic. Vincent, we're coming up on time. If folks want to follow along with what you're doing or get in contact with you, how do they go about doing that?
So Twitter is the best. I mean, that's, I don't like big tech, but I gotta say Twitter is where it's at for finance. My handle is at Vincent, VINCENT, Deluard, DELUARD. So you can follow me there. If you go to my pin tweet, there is they have a link where people can sign up for a free trial of my work. We grant it to everybody. Don't have to be an institutional investor. And then you can DM me, and then you can reach, if you trade commodities, if you trade futures, if you trade stocks, StoneX is, that's the best way, right? If you already have a relation with us, and we'll be very happy to get you on my list, or to get you to talk to some of my colleagues on the trading side who can help you open an account.
Vincent Deluard, StoneX, thank you very much, sir.
My pleasure.